Felix here, the market is flying and the Fed is hating it. There are reports of sherry glasses being thrown out of windows at the Fed, wood-paneled walls besmirched with brandy and all sorts of nibbles that Fed presidents nibble on while they are tearing out their hair because this market keeps going up. What do we want to know is, when does the Fed stop it? And why would they? Because a rally eases financial conditions, the exact opposite of what they've been working these last 6 months to achieve. And today we got one indicator out. That is the Fed's favorite inflation measure. And that's what we need to look at. And that'll tell us the whole story of when this is going to end in calamity or a Christmas rally. Before we get into that, get your hands on the NASDAQ benchmark, a full benchmark of every single NASDAQ 100 stock. Here it is in all its glory. You can filter by return on capital employed, by net income margin, by leverage cash flow margin, and so on. All the key data for all the important stocks that you may or may not own. It'll make you smarter. Trust me, it's completely free. felixfranz.org/NASDAQ. I'll snatch it away from you tomorrow. So get your hands on it today. You can click on file, make a copy, then you got your own copy. And we won't do another one for at least 3 months. So get your hands on that. Of course, none of the following is financial advice. It all comes from Winston, my golden retriever. I hope you know that by now. And let's jump straight into the real hard, cold facts here. What did we get out today? We got the University of Michigan expected changes in prices. That doesn't sound like the most riveting set of data, but trust me, it is. There's nothing quite as exciting as a bit of inflation expectations. What is it? So for the present, for 1 year ahead, the survey says we are going to have 5.1% inflation. Now, that's a pretty ugly number, but the problem is that it's gone up for 2 months in a row here. It's just going up. And the Fed doesn't like that. The Fed is incredibly worried about inflation expectation being unanchored, as they call it, because that means you demand higher wages and so on. It just continues. And even the 5 to 10 year expectation down here is up for the second month in a row, now sitting at 3%. So this is a bit of a red line for the Fed. It's going to make them very worried. So what are you going to expect them to do? Well, let me tell you what they're going to do. So here is the data. Here it is, 3% and 5.1%, which is higher than last month and the second month in a row. So what are we going to get? We're going to get Fed President Waller on Sunday and Brainard on Monday, and they are going to be shouting as loud as they can that nothing has changed, nothing's decided, and they will fight inflation on the beaches and everywhere else. So prepare for that. That's what's going to come out on Monday. We're also getting consumer inflation expectations again on Monday. So watch for this number. If this 5.4 number was last month, comes in higher than expected, we are a little bit in trouble with our pre-Santa rally here. Another word of warning, and don't worry, this is not going to be a gloomy video here, but I want you to walk you through a few data points that I think are really important to understand. When you get these massive trends changing, so like the Japan no longer being worth the whole world together, the dot-com bubble here, this one, that was the dot-com bubble. I remember working in a dot-com company at the time. The lights went out and so on. When these things happen, the resources bubble, the BRICS bubble, the banking bubble, all of these things take time to recover. The FANG stocks are right here in glorious pink for some reason. And we haven't fallen that far, and it might take some time to recover. That's at least what Bank of America says. So obviously take that with a pinch of salt, but just think about the time frames for these things. Now, we've had incredible moves away from treasuries. So people are getting out of bonds and bond yields dropping. Bond yields dropping, not people getting out of bonds, wrong way around. Bond yields dropping, and that, of course, makes stocks more appealing. It's the biggest change that we've had since 2008 financial crisis. And there are quite a lot of similarities we're getting with 2008 lately in terms of volatility, which is a little bit concerning. Something to think about. JP Morgan sums it up quite nicely here. There it is on the screen, a trader at JP Morgan. He's saying, look, intermediate treasuries experienced the largest one-day decline since March 2009. And Fed officials have ratified a downshift as in they've agreed that there will probably only be a 0.5% hike, but have also cautioned that this does not mean a pause and that the path to lower inflation will be neither swift nor linear. So far we've got one data point. We haven't got a lot of data points. Oh, here's some data points. I always share with you guys my trades. These are the trades for the last 4 days, which are wonderful. We are up, I think on Disney, I think it was 11% in 2 days, 13% on AVGO in 1 day, Costco 12% 2 days, Intel 7% 1 day. Is that a little bit of luck? Yes, but we would have made money on these trades anyway, just not quite as quickly. So we made $1,100 in the space of 2 days, which is pretty nice. I shared all of those trades with you guys, of course, live in the community. I'll tell you how you can get into the community in a second here. Now, what's the positive news? There must be some positive news here, surely. Hedge funds are still very, very, very short, right? So they are not in large cap tech, which is the blue line here. This is tech, large cap. And then there is in sort of brown amber here, unprofitable tech, so kind of growth. And they are not really in either of them, which is interesting. Very, very, very low levels. So that means there is a lot of room for money to actually flow in. You want people to be positioned that way when things are going up. Now, Goldman's are pretty gloomy on this whole thing. They're basically saying, we don't like it. We think it's just a reaction. It's an overreaction. We still think that there is, inflation, blah, blah, blah. But the CTA momentum, CTA are technical driven funds, so funds who trade on charts and a little bit of fundamentals, but essentially on indicators. That volume is now positive, and the demand from this community is going to explode, says Goldman Sachs. And they're saying, well, apparently it's going to be billions of dollars of buys from the CTA community. That's going to ramp up. And also, CPI, China, Russia developments are so on. It's steps in the right direction, but, and I can really only echo this, proceed with caution and remain laser focused on quality. Don't buy the junk. I know the junk's flying up the most, but don't buy it. We also have potentially a liquidity crunch, and that's why we're seeing such big moves here. So very low volumes today. Why? It's Veterans Day. And we do have a free program, by the way, for veterans. If you check it out on the website, go to academy.org. What was I going to say? I got sidetracked about the free program for veterans. We've had that for some time. When volume is low, a few buyers can move the market a great deal. So you get a lot of volatility, and then potentially liquidity crunch, which gives you these squeezes up. And this is kind of what we're seeing today. So be cautious. The Fed is definitely hating this. That doesn't mean we can't make money out of it. We really are. Like, we're up so far just this month. We're up 20%, which is lovely. But we're also up every other month except for September. We are very, very nice and consistent. We're up 118% so far on the year. And how do we do that? We don't do that by betting on something to really go in one direction or another. We are essentially market neutral. We make money out of volatility, not really stocks. That's how options trading works. Options is not some sort of weird leverage for stocks. I know a lot of people think that, but it isn't. It's an asset class on its own. And the trading protocol I've developed over many years is a risk management, essentially, that I share with you to show you how you find the trades and so on. So if you have a 5-figure portfolio, then you potentially qualify for our coaching. Give us a ring at felixfriends.org/coaching, and we'll walk you through it, answer all your questions. If you're just starting out with your portfolio, you're not quite at 5, 6, 7, 8, 9 figures yet. Also brilliant. It's the most exciting place to be. Have a look at our course. We've got 100 pre-recorded lectures there. You get to see me trade live every single week. I literally just did a live trading video before I recorded this one. So go to felixschwanz.org/options, read about the details, come and join us. All of our programs are have guarantees, so check it out. So what's my summary here? I don't mean to be gloomy and doomy. I'm not one of those people. I just think we need to be wary of what's going on here in the market. And that there is a bit of overexcitement, and I know we're making nice returns and all of that, but we can make money in all markets. And I think once you master that, once you understand that, once you really get that, you don't need to buy a leveraged fund on a day like yesterday to make a lot of money. In fact, by doing that, you are likely going to lose a lot of money because these things can flip very, very quickly. But at the moment, the fundamental setup for me looks relatively positive because we've got CTA money coming in, we've got buyback money coming in, core wall has moved to 4,100. It's a lot of reasons for this market to squeeze up at the moment. But watch for these data points. This data point today got ignored, and that's kind of dangerous. The market didn't come down at all. People just looked at the falling consumer sentiment and thought, brilliant, recession, here we go, the Fed won't do as much. And the Fed has still got its eye very much on inflation. So watch out for that reading on Monday and, tread carefully. That's what I'd say. I appreciate you watching. Thank you very much. And I hope to see you on the next one.